Monetary policy is an essential tool employed by central banks worldwide. It plays a crucial role in steering the ship of economic stability, growth, and prosperity. In this video, we'll look into the intricacies of monetary policy, the terms hawkish and dovish, and the essential tools used by central banks. What do the terms hawkish and dovish mean? Hawkish and dovish are terms used to describe different types of monetary policy. When it comes to monetary policy, being hawkish means keeping a sharp eye on inflation and swooping in to control it. Whereas the term dovish refers to the economic policy advisor who advocates for monetary policies involving low interest rates. What is monetary policy? Monetary policy refers to the actions and measures taken by a country's central bank or monetary authority to manage and control the money supply, interest rates, and other monetary variables in an economy. Monetary policy is one of the key tools available to policymakers to be able to influence economic conditions of a country. Central banks use a variety of tools to implement monetary policy. Here are some of these tools. Number one, interest rates. By raising or lowering interest rates, central banks can influence spending and investment decisions impacting economic activity. Number two, open market operations. Through the buying or selling of government securities, such as treasury bonds or bills in the open market, central banks can control the money supply. Number three, reserve requirements. Central banks can influence the amount of credit available in the banking system and control lending activities by adjusting the minimum amount of reserves that banks must hold against their deposits. And number four, quantitative easing. This involves purchasing large quantities of government bonds or other financial assets to increase the money supply and stimulate economic activity during times of economic crisis or low interest rates. So what are the main differences between the hawkish and dovish monetary policies? Let's start with the hawkish monetary policy. It focuses on controlling inflation as its primary objective. Its main aim is to maintain price stability by keeping inflation levels low and within a target range. This involves raising interest rates to curb borrowing and spending, which can help reduce inflationary pressures. Higher interest rates make borrowing more expensive, discouraging businesses and consumers from taking on excessive debt. The hawkish policy also involves reducing the money supply or limiting its growth. Hawkish policies tend to prioritize fighting inflation over stimulating economic growth. By raising interest rates and limiting credit, it can slow down economic activity, including consumer spending and investment in the short term. And this is the basis of a dovish monetary policy. A dovish monetary policy prioritizes promoting economic growth and reducing unemployment. It's more lenient towards high inflation in the short term to support economic expansion and job creation. A dovish stance typically involves lowering interest rates to encourage borrowing and spending. Lower rates make borrowing cheaper, stimulating business investment and consumer spending. The dovish policy may involve expanding the money supply through measures such as buying government securities or lowering reserve requirements for banks. This increases the availability of credit, thus making it easier for businesses and individuals to borrow. By doing this, it encourages borrowing, investment, and spending, which can promote economic growth in the short term. However, there's a risk of higher inflation if not carefully managed. Central banks often adopt hawkish or dovish policies depending on their own assessments of the economic situations in their country. This includes inflation levels, employment rates, and overall economic performance. And make sure you follow XCB to learn more about trading and investing.